What's going on, everybody? Welcome to the Gray Report. I'm your host, Spencer Gray. And on the Gray Report, we go over everything that happened in the multifamily industry, real estate, and the economy. So if you are a real estate investor, you're just interested in investing in multifamily apartments, or maybe you're already doing it, you're in the industry, you're an industry insider, this is the weekly video report that you need to see to kind of stay up to date. All the recent research reports, articles, that's what we cover kind of every week here on the Gray Report. And it's a great accompaniment to the weekly Gray Report newsletter. So without further ado, let's just get into the report. All right, everybody. Once again, Matt Bosnagel, Director of Communications and Marketing over at Gray Capital. He is with us again to help us break down, figure out what's going on. It's like every week we say this has been a crazy week. But this whole year, the past 18 months have been insane. And it just keeps getting interesting. Exciting time for multifamily in the economy. If you just track markets in general, it's been very fascinating. I think we're living in kind of new economic times. But Matt, inflation worries grow. We've talked about inflation a lot.
Yeah.
You can go back to the videos we were doing like in January, even before in 2020, we saw kind of this inflation writing on the wall, spending, supply chains, all of that. Now the conversation is saying, okay, maybe this is not as transitory as we once thought. But what's your take? What do you see going on?
Yeah, we'll get into the discussion on like the kind of raw numbers, but the reaction to inflation has led to some significant volatility in the stock market. At the same time, home prices and multifamily rents are really continuing their upward ascent. It has been a crazy week, but if you're just focused on multifamily, there's really hasn't been any bad news. And supply chain problems, maybe that could be bad news in terms of like development and continue to create housing supply. And that actually seems like more of an immediate effect, whether it's felt personally by retail consumers or really like builders and developers they're really feeling the impact of these logistics related delays that have increased the cost and the time required to move goods and materials. But yeah.
It's interesting. And I guess I wanted to ask you, Matt, because we've talked a lot about increased supply costs and, lumber was crazy prices, whether it was $1,500 per random length future of lumber. Now it's down to the kind of the 600 range, but so many materials have been going up and down. At the same time, there's a huge demand for housing. But what do you think about like the psychology for developers and also just investors who are looking at, doing large renovations? The psychology of there being a little bit of hesitancy to build new because you don't know what your input costs are going to be. You don't even know if you can find the labor to get things built. I'm just curious what you think of that psychology of, there's the demand, but can I even do it? Do I have the resources?
I haven't had conversations with developers, but it seems like in terms of like investors pursuing investment, we talked about this last week. There really hasn't been a let up in terms of like permits and starts.
It's true.
Those things are continuing, and I think at least on the investor side, investors are seeing these numbers and they're thinking maybe it's going to cost a little bit more to build, but you're going to be able to make it back because the rent growth is there, and there's such a huge need for housing. I think that the headlines that we were reading last week was demand continues to outpace supply, and I think at least from my perspective, the demand for housing is outpacing maybe the price increases and delays related that may dissuade some developers to build more. It may be the reason why they're not building is just because it's not arriving in time. Maybe not because they don't want to, but it's just impossible.
Yeah, no, I think that's a good point. There's definitely the interest and people are taking steps. The permits are being, at least pursued and being issued. I still think there's a difference between making the plans, getting the permits, and getting the materials and getting the labor. And okay, is it going to turn what usually takes, say, an 18-month project, and does that turn into 24 months or 36 months? And does that just, again, it just extends the timeline to get us this much needed supply. But it's interesting. Okay, so let's get into the report. Let's get into some of the articles. Again, you can get these articles sent to your inbox every Thursday morning by signing up for the Gray Report newsletter. Hop on over to graycapitalllc.com/newsletter. Just fill out the quick form. So the Gray Report, inflation worries grow. That's exactly what we've mentioned. On the newsletter, we show you a quick market snapshot, what's going on, critical markets, indices, rates. Interesting article from the Wall Street Journal. Matt, bring us in. Broader inflation pressures begin to show. No one can make up their mind, but it seems like now people are starting to come around to the fact that, okay, this inflation story is sticking around a little bit longer. What's the Wall Street Journal's take, and what's your take?
Yeah, I don't want to characterize this as usually the inflation articles that we read are either doom is coming or don't worry about it, it's all supply issues, things are going to go away. Yeah. This one is saying that actually doom is not coming, but things are not going to go away. And I know it's kind of splitting the difference, and inflation is complicated. And the other upshot to this article, which I really think is a really interesting article because it uses these different indices and methodology to look at inflation on different levels. What's interesting is that we will probably, if this is hard, it's hard to predict inflation. That's kind of the thing. They're all kind of saying a little bit different, and some people are kind of throwing their hands up to a certain extent and saying like, well, we don't know how much. Maybe last month's increase in airline tickets, decrease in airline tickets has kind of leveled off the CPI. So there's lots of moving parts to inflation, but in all, disaster's not coming. But the worries are beginning to grow. And that's why I kind of headlined it as the inflation worries are growing, maybe not inflation disaster, but the reaction to it is still worth watching.
I just wanted to show it's got to keep watching it. And I'm not trying to toot our own horn, but it's almost kind of like what we've been, I feel like, saying, like, yeah, we're going to see inflation. Maybe it's not going to be crazy. And the economy has actually been like clamoring for some inflation for years. Yeah. And we need it with all this debt to kind of erode the debt. Unfortunately, the losers in all of this are kind of your regular working people whose wages aren't going to be rising as fast as goods and services. So I just want to look at this real quick. Comparing the 10-year break-even inflation rates to the 5-year break-even inflation rates, because it is, you see that we were down below 1% inflation for the longest time, even going back much longer. We had always kind of hovered in around this 2% what the Fed was targeting, and that had been declining for quite some time. And then we were in deflationary spiral during the pandemic, and that's popped up. Now, it's not too much far outside of kind of that normal historical range, though. So it's not that crazy. We're really just kind of at normal break-even inflation rates now. But what I think is different is the 5-year break-even inflation rate is definitely elevated now, not as much elevated kind of pre-great financial crisis. And I wish this graph went back even further. I don't think, this is as far back as it goes, but we're significantly higher inflation than we were seeing again this past decade. But again, looking at this 10-year, we were not growing, and the inflation was under what you would typically want to see in a growing economy. We were really kind of doing this slow growth, not zero, but it wasn't looking good. So some of this is kind of good. And that's where we've talked about this kind of Goldilocks scenario, potentially. And it's kind of hard. It's hard to call that because no one thinks it's a sexy call to be like, you know what? I think things are going to work out relatively okay. And maybe it's like,
that doesn't get the clicks.
Doesn't get the clicks. It's either got to be, huge upside surprise. Really not even that. Everything's gonna be really good. Like no one takes you seriously. Yeah. It's much easier to say everything's going to be horrible.
And then if you're wrong, it's like, so there's no doom. Aren't you happy?
Yeah, exactly. Yeah. What are you complaining about? And then you just need to keep saying that everything's going to blow up constantly. And then every 10 to 15, 20 years, it happens. You say, see, this is what I've been talking about.
Yep.
It's a whole broken clock is right, twice a day. So we'll keep tracking it. We'll see. I think a lot of this is seeming to be supply chain issues. And again, I think a lot of people thought that a lot of this would be kind of worked through the system by now. And it's just, it's lasting a little bit longer.
What is interesting is, and inflation does seem to be decelerating a little bit, whether that's due to short-term decreases in used cars and plane tickets because the Delta variant remains to be seen, but it does seem to be decelerating. The only thing is, some of these indices do indicate that inflation will remain elevated for some years out. So I think that's maybe a more important thing is to factor in now. Maybe that we're going to have this. It's not just going to go away.
I think it's not going away anytime soon, at least not 6 months next year. Two things that we're not mentioning that we're going to get some more information on. Really, it's happened in the past day or two, but it's not computed in the CPI numbers we have right now. And then we've got jobs report coming out tomorrow. So, but one thing, energy prices, oil and natural gas. Natural gas is doing a huge spike. Europe, it's especially an issue. They're totally relying on Russia. And there's fears if it's a strong winter this year, gas prices are just going to be unsustainable. We all talk at the pump, gas prices are high, thanks Joe Biden. And that's a major component of CPI also. And so those have been recent increases. So I'm curious, I guess I see CPI kind of bumping up again. And then wages that's that huge, I mean, that can really push inflation because that's like the biggest input costs to goods and services. And we're going to get I think we're getting wage data out. Actually, I think we've gotten out today. I think ADP came out with payroll information, and I think we're getting unemployment figures tomorrow. So we'll have to we'll update everybody once we get those figures in. But that's what I'm kind of waiting for to see. Okay, how much are we decelerating? Which we want to decelerate a little bit, because we're going, to your point, we don't want to see that crazy growth. It's unsustainable, and things are going to get misaligned and out of place. We need everything else to kind of catch up. But a little bit of moderate growth isn't bad. So it'll be interesting to see if we're just moderating or if we kind of accelerate a little bit. Matt, one thing I wanted to ask you about, just while we're on this topic of inflation, is there's this talk of stagflation where we have kind of this sputtering economy, but prices are rising. Not much productivity, but prices are rising, which is not good. Any thoughts? You think we're going towards a stagflation?
I don't see that. I think that there's so much resistance to I think wages, that's going to be the big thing is if wages start to go up, maybe we'll see that, and then people not a lot of business are very interested in raising wages right off the bat. And I think that we are seeing some resistance, I think, and we'll get into this. We talked about this yesterday when it came to rents in certain places where there was a high level of rents where people just weren't willing to pay. Now, I think that once the dust settles, we'll be able to know exactly, again, all this supply stuff. But I am a little bit reassured by the fact that that people have limits to what they want to spend, whether it's on the wages or what have you. But isn't that how it starts though? Is they're like, hey, I cannot pay you $20
an hour, but then they don't have anyone there, and so they're like, okay, if I want to stay in business, I'm going to have to pay somebody $20 an hour. I'm just going to have to raise all my prices. And it just, and so it's just a cycle. I was at CVS yesterday and I heard the conversation, someone asking the person working at the front desk, checking people out. They're asking about what their wages were. And they were like, well, starting salary is $12 an hour. In my mind, I'm like, no one's not hiring anybody at $12 an hour now.
That's a good point. If we start to see because right now there's more job openings than there are job applicants. If that gap starts to decrease, then maybe that's because the wages have increased enough to motivate people to come to fill those jobs. and then that may start some kind of spiral. But I'm not quite sure if we're there yet. I haven't seen a whole lot of news about the potential for stagflation, and it may be because we have this weird employment situation where some people are just willing to, they're willing to wait for that.
I've just heard it being brought up multiple times in a serious conversation. The first time being like, we don't even want to mention this, and then it's like, what are your
Yeah.
and then like the next day it's like, well, what are your thoughts on stagflation? But I think it's a good point. I think it's another boogeyman out there that's interesting and fun to talk about. But in any environment, this would be the time to be watching for that scenario. Matt. Yardi Matrix, National Multifamily Report, September 2021. Yardi consistently puts out great reports, monthly reports, rent growth, employment information, occupancy, all kinds of good KPIs that kind of keep us on the pulse of what's going on in national markets, but also local markets. And I'll just read this summarize the 3 bullet points real quick. And then Matt, I would love to get your takes. Asking rents nationwide continue to break records though the market shows signs of deceleration. Nationally, asking rents were up 11.4% year over year in September. However, monthly rent growth was $16, a rate of 1%, which is the lowest monthly gain since the market began to accelerate in March.
Yeah.
Sunbelt tech hubs are still leading the nation in rent growth as markets in the Southeast and Southwest benefit from rapid domestic migration and job growth. Migration story has been playing out for a number of years, but accelerated quickly during the pandemic. Single family, build to rent, rents continue to grow at an even faster pace than multifamily, with national rents up 14.3% year over year. Occupancy keeps rising as well, up 1.2% year over year. So similarly, like we were talking about, that's why we pay attention to the macro side as well as the granular side, that we were seeing a little bit of deceleration. Question to you, Matt. How much of this is a story of the general market cycle? How much is this seasonal? Because we are outside of peak rent season and you don't typically see as much rent growth being pushed in the fall.
Yeah, I would believe, and I think seasonal I think it's a good. Okay, so
sorry, I know. I kind of threw that one out, but in my mind,
no.
Maybe something.
I have a response for that.
Yeah,
I think that this is an interesting report, and it does signal development that we talked about last week in our discussions of the apartment list rent report. Apartment list talked about rents in Spokane and Boise, how they kind of have started to really significantly level off. And we were like, well, is this a sign that there is a ceiling now for renters? And it does appear, regardless of it's cyclical or not, and I'll return to that rents, while increasing rapidly, are starting to level off to a less manic, more reasonable level. I don't think this is cause for alarm. I don't think this is bad news, because it's not like they're going down and it's not like they're plateauing. And also a continued series of unprecedented rises makes investment more difficult, because it makes predictions harder to make. You don't want to be making an investment that assumes breakneck growth when things level off. And so when things return to kind of normalcy, and part of normalcy is a leveling off when the season, when seasonal demand drops off a little. So I think that would be that regardless, I think it's hitting that it is maybe hitting a limit and returning to more normal, and normal is still good, and there's still growth there. But I think that hopefully this will start to also kind of lessen the froth that we're seeing on the buyer side, and make things a little bit easier for investors to make more reasonable decisions.
I would love that for be the case. I am less hopeful every day of that being the case because of all this talk of inflation, and I feel it being taken more seriously now than it was taken a couple weeks ago.
Yeah,
because a couple months ago, it's like transitory in nature. Even though people would say no, it's not going to be transitory. People would say that, but they weren't like taking actions, believing that it wasn't going to be transitory. If you are convinced and believe that we are in an inflationary environment, sophisticated investors are going to start allocating their portfolios in an appropriate manner, which means they're going to be overweight to real assets, specifically commodities and real estate. At the same time, there is a global chase and search for any kind of yielding investment, getting any kind of income, any kind of return. I mean, I can't tell you how many conversations I've had in just the past 7 days about large institutions, sophisticated investors, family offices, developing these relatively complicated option strategies to produce income to yield 3 to 4%. Taxable. And because bonds are real yields are negative. Munis, which you get some tax advantages, aren't even yielding 4%. You're getting 2 to 3, maybe 4% for some low rated municipality or whatever. Where else are you going to get income? How else are you going to hedge against inflation? Real estate makes the most sense, because it is a hedge against inflation, and it also provides income, whereas commodities do not. And commodities are in a weird place right now with cryptocurrencies and all of that. But there's going to be, I believe, one, it's already started. Two, I think we're still in a very early innings of a huge shift to allocating out of public markets into all private placement alternative assets, specifically real estate. And we've talked before, Matt, about how multifamily real estate has some very unique characteristics because you are constantly releasing units, and so you're able to track inflation at the rate of your leasing versus other commercial real estate where you're signing leases that may be for 3, 5, 7, 10 years in duration with predetermined rent increases, and so your rate of increase is fixed and will not necessarily keep up with the rate of inflation. And sorry, the long rant to say how I disagreed with just the idea that, or just with the idea and the dream that I share, that people
are going to stop paying attention.
People will stop paying attention, and we can get in there and buy some great assets that are going to have great cash flowing opportunities. I think it's going to continue to be difficult. For the foreseeable future.
And even talking about rent growth, and I was kind of trying to downplay it because it was part of my argument. It says that one of Yardy's conclusions says that although growth will slow in 2022, rent gains will remain strong by historical levels. So this, and you had that graph up there. The leveling off doesn't really look like much of a leveling off. It's
sorry,
still,
I'll bring it back.
And that's fine. The slope is still pretty steep compared to that flat line that we saw earlier in the measured period. I think that inflation is the factor that I wasn't thinking about, and I think it's an interesting point that you bring up is to have these assets that continue to pace with inflation, and the fact that when all of this inflation was discussed, the real reactions were seen in the stock markets. They kind of saw this as an alarming thing, and like I mentioned earlier, in the multifamily world, there was no big, huge alarms. This was not,
there wasn't. Well, there wasn't. We know, and the big difference between, and it's a positive and negative, but it is a feature because the participants in the multifamily market, we can have the same emotions and all of a sudden be like, oh, I don't think these assets are valued X, and but they're illiquid assets. You can't just sell it. You can't make a decision, and that's where you're seeing. In the stock market, the price reflects the psychology and investor sentiment on any given minute of a trading day. And so we can see those fears represented in the price level, whereas you have a negative opinion on multifamily one day, you can't sell it to reflect the price. So there's no price discovery. And again, so it's almost, that's the illiquidity. While that's a disadvantage, in one regard, it's a feature in another way of creating just less volatility, and we can focus on the long-term nature of the fundamentals, and much more tied to fundamentals, where the stock market is hardly, very loosely related to fundamentals, at least with most stocks. So Matt, I want to keep going on this Yardi report, just kind of getting through a couple of things. Year over year rent growth. Yeah, sorry, go ahead, Matt.
They also talk about build to rent, and there was another. I think
we're going to get to that in a second. I think that's one of the next couple sections. I was just going to go over kind of the year over year rent growth first. Year over year rent growth, they break it down, all asset classes, lifestyle asset classes is always going to be your class A, and then renters by necessity, this is going to be, your class C and class B. The median for all asset classes, 11.4% year over year rent growth. And keep in mind that the average year over year rent growth is typically around 3%. Lifestyle asset class rent growth, 13.4%. Which I think it's interesting that the class A is at 13.4.
Yeah.
Renters by necessity, 9.5. Renters by necessity, national average is 9.5. And I think this reason is most easily explained. Two factors. One, higher income earners, renters by choice, have more disposable income and have probably been able to maintain their job. Maybe they've had a larger salary increase. They've got more cash and more savings than they ever have before. And they're deciding, they want to live in a nice place.
Well,
yeah, go ahead, Matt.
And I think this is a sign kind of recovery, because during the pandemic, when everyone was talking about K-shaped recoveries and how lower income people, that they were going to be worse off, while higher income people, they're going to be better off. The renters by necessity, those rents actually rose higher than the class A properties. So now we're seeing it kind of flip flop, and it could be a sign maybe of a little bit more recovery. People have more money to spend.
Yep. I think that is a good point. And there's new deliveries, raise the overall rent of the lifestyle asset classes. And just, so, Indianapolis, Matt and I were talking about this just prior, so we're like, Indianapolis is usually above the national average. I'm like, why is it a little bit below? And we're reminding ourselves that last year, and we talk about Indianapolis, that's obviously where we're based at. We have a lot of deals in Indianapolis. Indianapolis is among one of, probably I think 4 markets of the larger national markets that actually had positive rent growth in 2020, year over year rent growth. It remained positive for just pretty much the entire year. And I think it was the 3rd or 4th highest rent growth during the pandemic. And whereas almost every other market had negative rent growth. And so again, this is another good example of kind of a base effect of a lot of these other markets, like I'm just looking at like your Portland's, not really Las Vegas, but some of these larger markets that saw DC, decreases. Washington, DC, Portland, parts of Orange County, certainly LA, that saw major declines. And so, you're seeing 15% rent growth, but you had, 7% decline last year. So, your net, you're 8%, whereas Indy grew 4, now is up 9. So we're up, 15.
One thing that is interesting too is a lot of these seem like, there's a lot of gains in Tampa and Miami, but places like Phoenix and Las Vegas and Inland Empire, these are these adjacent areas to the expensive places to live. And it could suggest, there's some migration that's happening outside of these, they're still gateway cities, but there's a little bit of a shakeup there. And we saw this in, the breakneck rent growth in Boise that finally leveled off. So we could, I think that there's still going to be some shifting in this list. These number ones may not be number one for as long. But.
I think they could be. I think some will keep pushing because they're just so white hot. But I think some will probably cool a little bit. This is just the month over month growth. Again, Florida, Miami, Tampa, just killing it month over month. Both up over 2%. In either lifestyle or renters by necessity. Then it gets into employment, supply trends. I think this is interesting. We've talked about this a little bit, and we're going to talk about it more in another article. So Matt, this is what you wanted. This is what you were getting into earlier, and I apologize for cutting you off. But this build to rent, single family, build to rent, strong fundamentals fuel institutional investor demand. Again, build to rent. This is like, we're going to build a subdivision, but we're not going to sell to individuals. We're just going to rent these puppies out to typical renters, someone who might live in an apartment. It's the idea that people want more space. They want a yard. They want the American dream. But who says you need to go hundreds of thousands of dollars in debt to live the American dream?
Yeah. And I think that this is, and I hadn't finished this paragraph before I kind of speculated that this may not be a story of the incredible this incredible opportunity that single family rentals have been priced too low lately. I think that it is a story of millennials wanting to getting into home buying years, or getting into and starting a family and wanting more space.
Yeah, I think that's it.
They are continuing to rent. It is a higher appetite to rent rather than to buy a home, especially when home prices are this big. And I think that that's a positive development for multifamily ultimately, because there may be some people that instead of buying a 1-bedroom home, a small home, then they will rent an apartment. But ultimately, I think that the economics of multifamily is just that you can run a building with so many more units, and give a lot more people a place to live, a lot more efficiently than having a bunch of houses that are spread out. So
definitely true. I mean, it's the same story of, do you want to be replacing 5 roofs or 50 roofs? Yeah. There's a premium though that you can charge on the single family rentals that make it all, you can make it work. And I think if you, if it's centrally located, if you're like actually buying a subdivision, it's all in one neighborhood, you get some efficiencies there. You're not going all over town. And I guess technically you could always sell them off individually, so you have a slightly different exit plan. But I agree, they're never going to be as efficient as multifamily assets, and you can only do these in very suburban locations anyway. Also, and even in suburban locations, to amass that much land, it can be difficult to build it in an attractive location. And just again, sometimes apartments are just easier and more efficient to build to get more units in. So interesting.
Yeah.
It's very interesting development though. And again, sorry, go ahead, Matt.
Oh no. And I do think it is an interesting development. And I think that what I wanted to kind of say essentially is that I don't think that single family rentals are eating multifamily's lunch. I think that this is a reaction to shifting demand, and they're still, and that shifting demand does not mean bad things for multifamily. But that's, again, this is they're just starting to track this, and there's been so much shakeup, especially with the pandemic, where people have wanted more space. So it'll be interesting to see how this goes when from home so much.
Yeah, I think that's a good point. It's not single family rentals over multifamily. It's that we've got a housing shortage and housing crisis, and we need housing units in every shape and form, and just preferences from residents and from people are just a little bit different. Like you said, the pandemic kind of changed what our priorities were, and and maybe we mentioned this in the last episode, but we're looking at putting in these little private yards in. One of our properties, we looked at a property that was doing it. It was really interesting to kind of have that feeling of your own space, and you don't feel like you're just in a little box by any means. Yeah. Just the only other thing to mention, I think, on this in this report is just occupancy. That's what's the other factor that's driving rent growth is, it's wages and supplies and all of that, but occupancy is, the market is so tight. I mean, we're going under contract for a property right now, and the market is 98% occupied. And the only reason why it's not 99% occupied is because, most properties are 100% occupied, but then you have your one or two properties that have either been managed poorly, they're going through a big renovation, and they're like 70% occupied. So it's bringing the average down to 98. That's a tight market. I mean, why you have to raise rents? I mean, that's just pretty straightforward supply and demand.
If you look at and they obviously have skewed the graph a little to illustrate.
And the top line number is 96, not 100.
Well, but even so, I think it is still interesting that occupancy differences between renter by necessity and lifestyle have come so close that they're virtually equal.
Yeah, that's a good point.
Which, they're taking, people are really just taking anything they can get.
And yeah, and it's hard to say why that is exactly, other than, just there's a lot of renters by, there's lifestyle renters by choice who are like, I can't find a house to live in, or I'm looking, or I don't want to buy into. I know I've talked to a lot of people who are like, we're going to decide, we've sold our house, we're going to just rent for the next couple of years and wait for the market to cool off. Mm-hmm. And the response to that is always good luck. We'll have it waiting for the market to cool off. But, renting maybe not be a bad option. Take that money, throw it into, invest in some apartments that you live in or don't live in, or put it in the market. Invest in something, and you'll probably do pretty well. So again, I recommend checking out this Yardi report. They put out a lot of good reports. We send these to you so you don't have to go search for them if you're subscribed to the Great Capital newsletter. So again, if you haven't done that, greatcapitalllc.com/newsletter, and you'll stay up to date. Okay, Matt, just last article we wanted to touch on, and this kind of harkens back, I think, to the conversation we had earlier, which is about inflation, et cetera, et cetera. This is a story from Yahoo Finance. Supply chains are everything at this point. Economist explains. Matt, explain what this economist is explaining.
Well, I am not a logistics expert, but I have listened to a few podcasts. Actually, one of them
that makes you an expert these days.
One of them has talked about how the logistics professors in the economics department are now the superstars. And, well, and everyone is paying attention to logistics now. It is in wonder
how many logistics professors there are. I mean, it's a big industry, but I mean, supply chain management is really important.
They're the cool kids now. I worked. I did marketing work for a manufacturing job in my previous life, and I remember being amazed at this. It's called just-in-time approach, where you don't get a huge inventory, you wait for things to happen, and then you will get your materials just in time. And I remember marveling at, how can you depend on this? How can you depend on things getting there just in time? Logistics is so complicated. How do you get that, that special screw or whatever, the sheet of metal that you want? Well, this is beginning to break down. Well, it's been broken down, really. And people are, it's hard to blame it on one thing. Is it dock workers, truck drivers, longshoremen, energy prices? There's so many moving parts, and all of them seem to have a problem. So I think that this is a much more immediate problem to the economy than the specter of inflation. We've seen pictures, and some people can look out their window and see long lines in ports, these expensive shipping containers, and you look out and you see a giant cargo ship that's just waiting to be unloaded, and there's not anyone available to help it, or just the resources aren't there to make this go evenly. I talked to someone that has a business just this weekend that they're relying on. It's not shipping containers, it's not overseas, it's just the trucks that can move it from across the country. That's their big bottleneck, is just the movement of goods and materials from place to place is causing a huge headache for businesses, and just for investors, really, to be able to predict what's happening. So
we should have our neighbors, our logistics
I have
company,
thought about that. Yeah.
who work in the office right next door to us. I feel like they've got a little bit of different swagger. Over the past couple of months, I feel like they're walking around thinking like they're the cool kids.
Yeah.
The office are like, we're in the logistics industry. I'm like, damn, you can tell me what's going on. When do I need to order my Christmas presents? Which that story that we talked about a month ago, Matt, that's not our story, but people are talking about that. There's CNBC was just talking about getting tracking the Care Bears like toys from China. They're like, how are we gonna? Does everyone have their Care Bears? And
now there is a small glimmer of hope. Supposedly, the price of shipping has dropped from 15,000 to just over 8,000. This is from China to the U.S. But I remember just last week you were telling me how some people are delivering empty shipping containers to China because that's cheaper than that's the only way they can get the shipping container.
Yeah, and they've got like the incentives and that's I read that. Who knows if what's true and what's not. Yeah. But yeah, there's a lot of weird things going on right now, to say the least. So we shall see.
And it does suggest some volatility and a little bit of a problem that could be solved. Like we said this about building and about supplies in general. If the price is high enough, hopefully that motivates people to take advantage of to fill that gap and to keep things moving. I hope that it's not a case that people aren't just there. But again, if they pay people more, that could significantly contribute to inflation. So it'll be interesting to see how we get our way out of this without moving, without some kind of.
And that's what I'm wondering is specifically this late fall and winter, businesses are just there. We need people to stock the shelves, to move the boxes, to drive the trucks. The option of not doing it and being behind and not getting these delivered would be catastrophic. So we're going to have to pay people a lot more. And do we see a surge in wages, albeit seasonally? But like we got to get this thing done. And do we see a surge in wages over the next couple of months?
And I don't know if you mentioned this in one of our videos or not, but yeah, you raise wages. It's pretty hard to lower people's wages. People don't like that. You'll get a lot more resistance than if you just don't offer a good wage. So that may be behind resistance. Once you raise those wages, it's hard to get it back.
Yeah, very hard. And you usually people just get laid off. It's not a reduction, and that obviously that's not good for the economy when that starts happening. But like, you got to get the stuff done. I mean, and not to go down a rabbit hole of talking about automation and robots and all of that, but at some point does it get to that? And I think we're already here in some ways. But okay, Matt, this was a great rendition of the Gray Report. I appreciate you coming on, as you do every Thursday. Again, it's a great newsletter. I think it is the best multifamily newsletter out there. I'm subscribed to a lot. They're all weak sauce, Matt, to be honest. And they're like, here's a thing. Here's like our original blog post, and we're like, here's our original blog post. We got videos. Here are 6 research reports, all taking different angles. Here's some articles taking different opinions. The economy, real estate, different asset classes. Again, I keep talking to people who are like, I read the Gray Report on Thursday, and I'm like ready to go. Everything I need is in there, and I'm staying on top of it. And then we try to do these to kind of fill in the gaps and kind of throw in our BS opinions about things and give a little color of just how we see the world. Whether if you appreciate what we're doing, good on you. Would love to have a like on this video. That'd be awesome. Matt and we will talk about that like. We'll be like, we got a like from, especially if if you give us a comment, shout out.
What did I get wrong? Tell me.
Well, or right or wrong. Any good comment, definitely going to get a shout out on the next episode. Unless it's like you're soliciting for your Forex training program, probably not going to get called out on that. But if you're like, hey guys, thumbs up, or hey guys, mention me on the show, definitely get a mention, and maybe a hat. We're gonna have hats. We will have hats. So give this video a like, subscribe. If you're ready to learn more about investing in multifamily apartments, that's what we do at Great Capital. We work with accredited investors, get them deployed into some awesome cash flowing multifamily apartments. And we do this all the time. We're going to have a new deal coming up. And greatcapitalllc.com, join the investment club. This will allow you access to the Great Capital investment platform, where we have our new deals pop up. Once you get your profile set up, investing in an opportunity is like, it's quick. It's filling out a couple forms, getting a letter signed, and then funding your account. That is really it. So it's not that long. We ask you a couple questions here, mostly to get to know you, making sure this is right for you. We don't want people to invest in it where it's right for them. We're trying to build an incredible portfolio of multifamily assets, really focus on doing quality deals, the right deals, not just doing anything, deals that we're excited about, we're proud about. We want you to be along for the ride. So greatcapitalllc.com. We'd love to have a conversation with you. You can schedule a meeting with one of our investment experts. Okay, we will catch you guys next week. Same time, same place on the Gray Report. Have a good one. Thanks.